Question 1. Benchmark analysis indicates that a client in California has entered into a privately negotiated agreement with a counterparty to purchase a specific quantity of a particular agricultural commodity at a fixed price for delivery in 6 months. This agreement was not traded on any organized exchange. Which of the following best describes this financial instrument and its regulatory classification under U.S. law? Option A. Futures contract, which is subject to regulation by the Commodity Futures Trading Commission, CFTC, due to its standardized nature. Option B. A forward contract, which is a customized OTC agreement not subject to the same direct regulatory oversight as exchange-traded futures. Option C. A spot contract, which involves immediate delivery and payment for the commodity. Option D. A swap agreement, which involves the exchange of cash flows based on underlying commodities. Correct answer is B. A forward contract, which is a customized OTC agreement not subject to the same direct regulatory oversight as exchange-traded futures. Explanation. This scenario presents a professional challenge because it requires a clear understanding of the fundamental differences between futures and forward contracts, particularly concerning their regulatory oversight and risk profiles within the context of the U.S. commodities market. Misidentifying these differences can lead to incorrect advice, regulatory noncompliance, and significant financial risk for clients. Careful judgment is required to distinguish between standardized, exchange-traded instruments and customized, over-the-counter agreements. The best professional practice involves accurately identifying the instrument based on its characteristics. A forward contract is a customized agreement between two parties to buy or sell an asset at a specified price on a future date. These are typically traded over-the-counter (OTC) and are not subject to the same stringent regulatory oversight as exchange-traded futures contracts. Futures contracts, on the other hand, are standardized agreements traded on organized exchanges, such as the Chicago Mercantile Exchange, CME, or the Intercontinental Exchange, ICE, and are subject to regulation by the Commodity Futures Trading Commission, CFTC, under the Commodity Exchange Act (C). Recognizing that the agreement is privately negotiated, tailored to specific needs, and not traded on an exchange is key to correctly classifying it as a forward contract. An incorrect approach would be to assume that any agreement involving a future delivery date and price is automatically a futures contract. This fails to acknowledge the distinct regulatory framework governing OTC derivatives versus exchange-traded futures. Specifically, classifying a forward contract as a futures contract would imply a level of exchange-based standardization and CFTC oversight that does not apply to privately negotiated forward agreements, potentially leading to misrepresentation of regulatory protections and risk management requirements. Another incorrect approach is to focus solely on the price and delivery date without considering the contract's standardization and trading venue. While these are components of both futures and forwards, they do not differentiate them. The critical distinction lies in the exchange-traded, standardized nature of futures versus the customized, OTC nature of forwards. Failing to make this distinction overlooks the regulatory implications and the different risk management frameworks applicable to each. Finally, an incorrect approach would be to equate the risk profiles of futures and forwards without considering their underlying regulatory structures. While both carry market risk, the counterparty risk associated with forwards is generally higher due to their OTC nature, whereas futures contracts have their risk mitigated by the clearinghouse. Mischaracterizing a forward as a futures contract could lead to an underestimation of counterparty risk and a misapplication of risk mitigation strategies. Professionals should employ a decision-making framework that prioritizes understanding the specific characteristics of the agreement. This involves asking, is the contract standardized? Is it traded on an organized exchange? Is there a clearinghouse involved? Is it a privately negotiated agreement tailored to specific parties? Answering these questions will lead to the correct classification and appropriate regulatory and risk management considerations. Question 2. The audit findings indicate a misunderstanding of typical short hedger roles. A farmer in Iowa who is preparing to harvest a significant corn crop is seeking advice on how to utilize the futures market. Which of the following best reflects the primary objective of this farmer in the context of hedging? Option A. To speculate on an anticipated increase in corn prices by taking a long position in corn futures. Option B. To profit from short-term price fluctuations in the corn futures market. Option C. To lock in a selling price for their anticipated corn harvest to mitigate the risk of falling prices. Option D. To engage in complex option strategies to maximize potential profits from market volatility. The correct answer is C. To lock in a selling price for their anticipated corn harvest to mitigate the risk of falling prices. Explanation. The audit findings indicate a potential misunderstanding of the fundamental purpose of hedging for certain market participants. This scenario is professionally challenging because it requires distinguishing between speculative trading and legitimate risk management, a core principle in commodity futures markets. Misinterpreting these roles can lead to inappropriate advice, regulatory breaches, and financial detriment to clients. Careful judgment is required to ensure that advice aligns with the client's actual business needs and regulatory obligations. The best professional practice involves recognizing that a farmer in Iowa who grows corn is inherently exposed to price risk for their upcoming harvest. Their primary business is agriculture, not commodity speculation. Therefore, their objective in using futures or options is to lock in a price for their anticipated production, thereby reducing the uncertainty of their income. This approach directly addresses their business risk and aligns with the typical role of a short hedger. This is correct because it accurately identifies the farmer's position as a producer with inventory risk and prescribes a hedging strategy that mitigates that specific risk, adhering to the principles of sound risk management as expected by regulators overseeing commodity markets. An incorrect approach would be to advise the farmer to take a long position in corn futures with the expectation of profiting from an anticipated price increase. This strategy is speculative, as it bets on market movement rather than hedging existing price exposure. It fails to address the farmer's core business risk and exposes them to potential losses if prices fall, directly contradicting the purpose of hedging for a producer. Another incorrect approach would be to suggest that the farmer engage in complex option strategies that offer unlimited profit potential, but also significant risk, without a clear understanding of the farmer's risk tolerance or business objectives. While options can be used for hedging, recommending strategies that are overly complex or speculative for a producer's core business needs is inappropriate and potentially violates suitability standards. A further incorrect approach would be to focus solely on the potential for profit from market fluctuations, ignoring the farmer's existing price risk. This perspective treats the farmer as a speculator rather than a hedger, leading to advice that is misaligned with their business reality and regulatory expectations for producers. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's business operations, their existing risks, and their specific objectives for using futures or options. This involves asking probing questions about their inventory, production cycles, and risk tolerance. The focus should always be on risk mitigation for the client's underlying business, not on speculative profit generation, ensuring compliance with regulatory requirements and ethical obligations. Question 3. The monitoring system demonstrates that a California-based Futures Commission merchant is reviewing a proposed regulatory change by the Commodity Futures Trading Commission, CFTC, that is expected to significantly alter the cost structure for certain types of hedging activities. Considering the development of the futures market under the Commodity Exchange Act C, which of the following approaches best assesses the potential impact of this proposal? Option A. Focus solely on identifying potential increases in trading volume that could arise from the new cost structure, assuming market participants will readily adapt. Option B. Dismiss the proposal's impact by assuming that market participants will easily absorb any new costs or complexities without significant behavioral changes. Option C. Conduct a comprehensive analysis of how the proposed changes will affect trading volumes, liquidity, hedging costs, and speculative incentives across various futures contracts, and develop adaptive business and compliance strategies. Option D. Prioritize identifying immediate profit opportunities from anticipated short-term volatility, without a deep dive into the long-term market development implications. The correct answer is C. Conduct a comprehensive analysis of how the proposed changes will affect trading volumes, liquidity, hedging costs, and speculative incentives across various futures contracts, and develop adaptive business and compliance strategies. Explanation. This scenario presents a professional challenge because it requires a Futures Commission merchant, FCM, in California to assess the impact of a new regulatory proposal on the development of the futures market, specifically concerning its obligations under the Commodity Exchange Act (C) and the rules of the Commodity Futures Trading Commission (CFTC). The FCM must balance its business interests with its regulatory responsibilities, ensuring compliance while also understanding potential market shifts. Careful judgment is required to accurately predict the market's reaction and its own operational adjustments. The best professional practice involves a comprehensive analysis of the proposed regulations' direct and indirect effects on market participants, trading volumes, and the FCM's own business model. This includes evaluating how the rules might alter hedging costs, speculative activity, and the overall liquidity of various futures contracts traded on exchanges regulated by the CFTC. The FCM should then proactively develop strategies to adapt its services, risk management, and compliance procedures to align with the anticipated market evolution and regulatory landscape. This approach is correct because it demonstrates a commitment to proactive compliance and responsible market stewardship, aligning with the spirit and letter of the CEA and CFTC regulations, which aim to ensure fair and orderly markets and protect market participants. An incorrect approach would be to solely focus on the potential for increased trading volume without considering the underlying reasons or the potential for increased compliance costs. This overlooks the possibility that the proposed changes, while potentially boosting volume in certain areas, could also lead to reduced liquidity in others due to increased regulatory burdens or shifts in hedging strategies. This failure to conduct a balanced impact assessment could lead to misallocation of resources and a misunderstanding of the true market development trajectory. Another incorrect approach would be to dismiss the proposal's impact by assuming that market participants will simply absorb any new costs or complexities. This ignores the fundamental economic principles of supply and demand in futures markets, where increased costs or reduced efficiency can directly impact trading activity and hedging effectiveness. Such an assumption could lead to a failure to adequately prepare for potential market contractions or shifts in participant behavior, violating the FCM's duty to operate in a manner that supports fair and orderly markets. Finally, an incorrect approach would be to prioritize immediate profit opportunities arising from anticipated short-term volatility without a thorough understanding of the long-term implications for market development and regulatory compliance. This narrow focus can lead to decisions that, while potentially profitable in the short run, could expose the FCM to significant regulatory risk and undermine the stability and integrity of the futures markets it serves, contravening the objectives of the CEA and CFTC. Professionals should employ a decision-making framework that begins with a thorough understanding of the proposed regulatory changes and their stated objectives. This should be followed by a multifaceted impact assessment considering effects on market liquidity, participant behavior, hedging costs, speculative incentives, and the FCM's operational capacity. Proactive engagement with regulatory bodies and industry peers can provide valuable insights. Finally, strategic planning should integrate compliance requirements with business objectives, ensuring that any adaptations support the long-term health and integrity of the futures markets. Question 4. Operational review demonstrates that a registered representative in California has taken a significant unhedged position in a commodity futures contract. The representative believes the market will move favorably and intends to profit from the directional exposure. The representative has not previously disclosed this specific type of unhedged trading strategy to their firm. What is the most appropriate immediate action for the registered representative to take? Option A. Discreetly attempt to offset the unhedged position with other unrelated trades throughout the day to reduce its visibility. Option B. Wait until the end of the trading day to report the position, assuming it will be closed out before then. Option C. Do not report the position, as it is a personal trade and the market is expected to move favorably. Option D. Immediately report the unhedged position and the trading strategy to the firm's compliance department. The correct answer is D. Immediately report the unhedged position and the trading strategy to the firm's compliance department. Explanation. Scenario analysis. This scenario is professionally challenging because it involves a registered person's personal trading activity, which can create conflicts of interest and potential violations of regulatory rules if not managed properly. The core challenge lies in balancing the individual's right to trade with the firms and the public's need for market integrity and protection from manipulative practices. The firm's internal policies and FINRA rules require diligent oversight of such activities to prevent abuse. Correct approach analysis. The best professional practice involves immediately reporting the unhedged position to the compliance department. This approach is correct because it aligns with FINRA Rule 4511, General Supervision and Compliance, and the firm's supervisory procedures, which mandate prompt reporting of significant trading activity, especially positions that could pose a risk or conflict. By proactively disclosing the unhedged position, the registered person demonstrates transparency and allows the firm to assess the risk, implement appropriate controls, and ensure compliance with all applicable regulations, including those related to market manipulation and insider trading. This action prioritizes regulatory compliance and ethical conduct. Incorrect approaches analysis. Failing to report the unhedged position and hoping it resolves itself is a significant regulatory and ethical failure. This inaction violates the duty of supervision and reporting required by FINRA rules. It creates an environment where potential market manipulation or conflicts of interest could go undetected, harming investors and market integrity. Attempting to offset the unhedged position through a series of smaller, unrelated trades without disclosure is also a serious violation. This constitutes an attempt to circumvent reporting requirements and could be construed as an effort to obscure the true nature of the trading activity, potentially masking manipulative intent or conflicts of interest. It directly undermines the firm's supervisory responsibilities and FINRA oversight. Waiting until the end of the trading day to report the unhedged position, assuming it will be closed out, is also professionally unacceptable. While the intent might be to avoid reporting a temporary situation, it still represents a failure to adhere to the prompt reporting requirements. Regulatory bodies expect immediate notification of potentially problematic positions to allow for timely assessment and intervention, not a post hoc justification. Professional reasoning. Professionals should adopt a proactive and transparent approach to all trading activities, especially those that deviate from standard hedging practices or could be perceived as risky. When faced with an unhedged position, the primary decision-making framework should be: does this activity require disclosure to my firm's compliance department according to internal policies and regulatory rules? If the answer is yes, immediate reporting is the only acceptable course of action. This framework prioritizes regulatory adherence, ethical conduct, and the protection of the firm and its clients. Question 5. Cost-benefit analysis shows that a new agricultural technology developed in Illinois is projected to significantly increase corn yields across the state within the next 2 growing seasons. As a Futures Commission merchant, FCM, registered in Illinois, what is the most appropriate course of action regarding your clients who hold positions in corn futures and options? Option A. Inform all clients about the potential impact of the new technology on corn supply and pricing, advising them to review their current positions in corn futures and options. Option B. Advise clients to ignore the news, as the long-term impact of new technologies is often uncertain and may not significantly affect current market prices. Option C. Immediately liquidate all client positions in corn futures and options to mitigate potential losses from a price decline. Option D. Selectively inform only those clients with large, open positions in corn futures about the potential yield increase, suggesting they consider hedging strategies. Correct answer is A. Inform all clients about the potential impact of the new technology on corn supply and pricing, advising them to review their current positions in corn futures and options. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a Futures Commission merchant, FCM, to interpret and act upon market information that could significantly impact their clients' positions and the firm's own risk exposure. The difficulty lies in discerning the true market sentiment and its potential effect on pricing, while adhering strictly to regulatory obligations designed to ensure fair and orderly markets. Misinterpreting the information or acting improperly could lead to regulatory violations, client dissatisfaction, and financial losses. Correct approach analysis. The best professional practice involves a thorough and objective assessment of the publicly available information regarding the potential impact of the new agricultural technology on crop yields in Illinois. This includes considering the magnitude of the projected yield increase, the timeline for its implementation, and its potential to influence global supply and demand dynamics for corn. Based on this objective assessment, the FCM should then communicate the potential implications to its clients, advising them to review their positions in corn futures and options in light of this new information. This approach is correct because it prioritizes client education and informed decision-making, aligning with the regulatory duty of care owed to customers and the principles of fair dealing. It also acknowledges the FCM's responsibility to maintain awareness of market-moving information and its potential effects on commodity prices, as mandated by the Commodity Exchange Act and CFTC regulations. Incorrect approaches analysis. One incorrect approach would be to immediately liquidate all client positions in corn futures and options without prior consultation or notification. This is professionally unacceptable because it bypasses the client's right to make informed decisions about their own investments and could be construed as acting in the firm's self-interest rather than the client's. It also fails to provide clients with the opportunity to understand the market developments and adjust their strategies accordingly, potentially leading to significant losses if the market moves against their positions. Another incorrect approach would be to ignore the information entirely, assuming it will not have a material impact. This is a failure to exercise due diligence and to stay abreast of market developments that could affect client portfolios. It violates the ethical obligation to act in the best interest of the client and could expose the firm to liability if clients suffer losses due to unforeseen market shifts. Finally, an incorrect approach would be to selectively inform only certain clients about the potential impact, particularly those with whom the firm has a more favorable relationship or those whose positions might benefit the firm if liquidated. This constitutes discriminatory treatment and a breach of the duty of fair dealing, potentially violating regulations against preferential treatment and insider information misuse. Professional reasoning. Professionals in this situation should adopt a systematic decision-making process. First, they must gather and objectively analyze all relevant information. Second, they should assess the potential impact of this information on market prices, considering both short-term and long-term effects. Third, they must communicate these potential impacts clearly and impartially to all affected clients, providing them with the necessary context to make informed decisions. This communication should be timely and transparent, ensuring all clients receive the same information. Finally, the firm should be prepared to offer guidance and support to clients as they navigate these market developments, always prioritizing the client's best interests and adhering to all applicable regulations. Question 6. The assessment process reveals that a registered futures professional in Illinois is preparing marketing materials for a new client seminar focused on commodity futures. The professional wants to emphasize the potential for significant gains. Which of the following approaches best adheres to regulatory requirements and ethical standards for promoting futures trading? Option A. Include a clear and prominent disclaimer stating that futures trading involves substantial risk of loss and is not suitable for all investors, while also presenting potential profit scenarios based on historical data and market analysis, explicitly labeling them as speculative outlooks. Option B. Focus solely on historical price charts showing past upward trends, suggesting that these trends are likely to continue and lead to substantial profits for attendees. Option C. Use language that highlights the unparalleled opportunity for rapid wealth accumulation and guaranteed profit potential to attract attendees, with a brief mention of risk in the fine print at the end of the brochure. Option D. Emphasize that the seminar will reveal secret strategies that have historically yielded consistent and substantial returns, implying a level of certainty in future outcomes. The correct answer is A. Include a clear and prominent disclaimer stating that futures trading involves substantial risk of loss and is not suitable for all investors, while also presenting potential profit scenarios based on historical data and market analysis, explicitly labeling them as speculative outlooks. Explanation. The assessment process reveals a common challenge in the futures industry, distinguishing between legitimate market information and potentially manipulative practices. Professionals must navigate situations where the line between aggressive marketing and misleading statements can become blurred, requiring a keen understanding of regulatory intent and ethical obligations. The scenario highlights the importance of accurate representation and the prohibition of deceptive practices designed to influence market behavior. The correct approach involves a commitment to providing factual and balanced information, clearly distinguishing between speculative outlooks and guaranteed outcomes. This aligns with the core principles of fair dealing and the prohibition of fraud and manipulation under the Commodity Exchange Act, C, and the regulations enforced by the Commodity Futures Trading Commission, CFTC, in the United States. Specifically, Section 6(c) of the CEA prohibits manipulative or deceptive devices in connection with commodity futures contracts, providing a clear disclaimer that acknowledges the inherent risks and the speculative nature of futures trading, while avoiding language that suggests certainty of profit, is paramount. This approach ensures that clients are making informed decisions based on realistic expectations, thereby upholding regulatory standards and ethical conduct. An incorrect approach involves using language that implies a guaranteed profit or minimizes the inherent risks of futures trading. This can be achieved through phrases that suggest a sure thing or risk-free opportunity, which are inherently misleading. Such statements violate the spirit and letter of the CEA by creating a false impression of certainty and potentially inducing individuals to enter trades without a full understanding of the potential for loss. This constitutes a deceptive practice. Another incorrect approach is to present speculative opinions as factual predictions without adequate qualification. While market analysis and outlooks are common, framing them as definitive outcomes rather than informed possibilities can mislead clients. This failure to differentiate between opinion and fact can lead to a misunderstanding of the speculative nature of futures markets, which is a violation of the duty to provide fair and balanced information. Finally, an incorrect approach is to omit crucial risk disclosures or to bury them in fine print. The CEA and CFTC regulations mandate that clients be fully informed of the risks associated with futures trading. Failing to prominently and clearly communicate these risks, such as the potential for substantial losses exceeding initial margin, is a direct contravention of regulatory requirements and an ethical breach. Professionals should employ a decision-making framework that prioritizes transparency, accuracy, and client understanding. This involves 1. Evaluating all statements for potential ambiguity or misleading implications. 2. Ensuring that all communications clearly articulate the speculative nature of futures and the potential for loss. 3. Actively seeking to educate clients about risks rather than downplaying them. And 4. Adhering strictly to all disclosure requirements mandated by the CFTC and relevant exchange rules. Question 7. The assessment process reveals that a commodity trading advisor registered in California is developing a novel algorithmic trading strategy for futures markets. To attract initial clients, the CTA is considering presenting back-tested performance data alongside a discussion of the strategy's theoretical advantages. Which of the following represents the most professionally responsible and regulatory compliant method for presenting this information to prospective clients? Option A. Presenting the back-tested performance data with a clear and prominent disclaimer that it is hypothetical, detailing the methodology used, the assumptions made, and a thorough explanation of the specific risks associated with the strategy, including its limitations and the conditions under which it may underperform. Option B. Focusing exclusively on the theoretical benefits and potential profit opportunities of the algorithmic strategy, while only mentioning that risks are involved, without specific details. Option C. Presenting the back-tested performance data without any specific disclaimers, assuming that sophisticated investors will understand the hypothetical nature of such results and the associated risks. Option D. Showcasing the back-tested performance data as indicative of future results, emphasizing its strong hypothetical returns, and providing only a brief, general disclaimer about the inherent risks of futures trading. The correct answer is A. Presenting the back-tested performance data with a clear and prominent disclaimer that it is hypothetical, detailing the methodology used, the assumptions made, and a thorough explanation of the specific risks associated with the strategy, including its limitations and the conditions under which it may underperform. Explanation. The assessment process reveals a common implementation challenge for commodity trading advisors, CTA, in California when developing and presenting new investment strategies. The core professional challenge lies in balancing the need to effectively communicate the potential benefits and risks of a novel strategy to prospective clients with the stringent regulatory requirements designed to prevent misleading or fraudulent representations. This requires a nuanced understanding of disclosure obligations and a commitment to transparency, especially when dealing with strategies that may have limited historical performance data or unique risk profiles. The best approach involves a comprehensive and transparent disclosure process that clearly outlines the strategy's methodology, historical performance, if any, with appropriate caveats, potential risks, and the CTA's qualifications. This includes detailing the assumptions underlying the strategy, the market conditions under which it is expected to perform, and the specific risks associated with its implementation, such as leverage, liquidity, and counterparty risk. This approach is correct because it directly aligns with the principles of investor protection mandated by the Commodity Futures Trading Commission, CFTC, and the California Corporations Code, which requires CTAs to provide full and fair disclosure of all material facts. Specifically, it adheres to the spirit and letter of regulations requiring advisors to act in the best interests of their clients and to avoid deceptive practices. An incorrect approach would be to present hypothetical performance data without clearly labeling it as such, and without providing a detailed explanation of the assumptions used in its generation. This is professionally unacceptable because it can create a misleading impression of the strategy's actual potential, potentially inducing clients to invest based on unrealistic expectations. This violates the regulatory duty to provide accurate and non-deceptive information. Another incorrect approach is to focus solely on the potential upside of the strategy while downplaying or omitting discussion of the associated risks. This is a failure to provide full and fair disclosure, as it omits material information that a reasonable investor would consider important in making an investment decision. Such an omission can be considered a deceptive practice under federal and state regulations. Finally, an incorrect approach is to rely on vague or generalized risk disclaimers that do not specifically address the unique risks of the new strategy. While disclaimers are necessary, they must be tailored to the specific investment being offered. A generic disclaimer is insufficient to meet the regulatory obligation of informing clients about the particular dangers inherent in the proposed trading methodology. Professionals should adopt a decision-making process that prioritizes client understanding and regulatory compliance. This involves a thorough review of all marketing materials and client communications by legal and compliance personnel, a commitment to documenting all disclosures, and a proactive approach to anticipating potential client misunderstandings. The guiding principle should always be to provide prospective clients with all the information they need to make an informed investment decision, even if that information highlights potential downsides. Question 8. The performance metrics for a commodity pool managed by a California-registered commodity pool operator show a substantial increase in net asset value over the past quarter. Which of the following represents the most appropriate communication strategy regarding this performance? Option A. Highlight the performance as a direct result of proprietary trading strategies, downplaying the impact of broader market movements. Option B. Present the performance metrics in a balanced manner, including both the gains and any significant volatility or risks experienced during the period, alongside a reminder of the inherent risks of commodity trading. Option C. Emphasize the significant gains as evidence of exceptional management skill, without detailing specific market conditions or potential future risks. Option D. Use the strong performance figures to immediately solicit new investors through direct outreach, without providing a full disclosure document. The correct answer is B. Present the performance metrics in a balanced manner, including both the gains and any significant volatility or risks experienced during the period, alongside a reminder of the inherent risks of commodity trading. Explanation. The performance metrics show a significant increase in the net asset value of a commodity pool managed by a commodity pool operator, CPO, registered in California. This scenario is professionally challenging because, while positive performance is desirable, it can create pressure to misrepresent or overstate the pool's success, especially if the CPO is seeking new investors or facing redemption requests. Careful judgment is required to ensure all communications are accurate, balanced, and compliant with regulatory standards. The best professional approach involves presenting the performance metrics in a balanced manner, including both positive gains and any associated risks or volatility experienced during the period. This approach is correct because it aligns with the regulatory requirement under the Commodity Exchange Act, C, and CFTC regulations, specifically Part 4, to provide prospective and existing participants with fair and accurate information. Ethical practice dictates transparency, and disclosing both upside potential and downside risk is crucial for informed decision-making by investors. This also reflects the spirit of the National Futures Association, NFA. Interpretive Notice 93-12 regarding advertising and communications. An incorrect approach would be to highlight only the substantial gains without mentioning the significant price swings or the specific market conditions that contributed to the performance. This is a regulatory failure because it creates a misleading impression of consistent, low-risk returns, violating the principle of fair representation and potentially inducing investors to commit capital under false pretenses. It also fails to adequately disclose the risks inherent in commodity futures trading, as mandated by regulations. Another incorrect approach would be to attribute the performance solely to the CPO's proprietary trading strategies without acknowledging the influence of broader market trends or external factors. This is an ethical and potentially regulatory failure, as it could be construed as overstating the CPO's individual skill and foresight, which may not be fully supported by the data and could mislead investors about the true drivers of returns. A third incorrect approach would be to use the performance metrics as a basis for aggressive solicitation of new investors without providing a comprehensive disclosure document, like a disclosure document, or detailing the risks involved. This is a clear violation of CFTC regulations that require specific disclosures to potential pool participants before they invest, and it bypasses the essential risk disclosure process. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves a thorough review of all performance data, ensuring that any positive highlights are contextualized with relevant risks, disclosures, and market realities. Communication should always be balanced, truthful, and designed to enable investors to make informed decisions, rather than to simply attract capital. Question 9. Stakeholder feedback indicates a client of a Futures Commission merchant, FCM, in Ontario, Canada, has requested to initiate a series of trades with the ultimate intention of taking physical delivery of a large quantity of a specific agricultural commodity at a non-standard delivery point. The FCM's compliance department is concerned this unusual delivery request might be a precursor to a manipulative trading strategy. What is the most appropriate course of action for the FCM? Option A. Conduct a thorough investigation into the client's commercial intent, financial capacity to handle physical delivery, and the potential market impact of the proposed delivery, while ensuring compliance with Ontario Securities Commission (OSC) regulations. Option B. Facilitate the delivery by discreetly encouraging other market participants to offset their positions without fully disclosing the client's specific delivery intentions. Option C. Immediately reject the client's delivery request due to its unusual nature, citing potential market disruption concerns. Option D. Proceed with executing the trades as requested by the client without further inquiry, assuming the client's intentions are legitimate. The correct answer is A. Conduct a thorough investigation into the client's commercial intent, financial capacity to handle physical delivery, and the potential market impact of the proposed delivery, while ensuring compliance with Ontario Securities Commission (OSC) regulations. Explanation: this scenario is professionally challenging because it requires a Futures Commission merchant (FCM) to navigate the potential for market manipulation and ensure fair execution of trades, even when faced with unusual delivery requests. The FCM must balance its duty to its client with its obligation to uphold the integrity of the commodity futures market in Ontario, Canada, as governed by the Ontario Securities Commission (OSC) regulations. Careful judgment is required to distinguish between legitimate, albeit unusual, delivery requests and those that might be designed to exploit market mechanisms. The best professional approach involves a thorough investigation into the client's intent and the feasibility of the delivery request. This includes verifying the client's capacity to take or make physical delivery, understanding the commercial purpose behind the request, and assessing any potential market impact. By engaging in this due diligence, the FCM can determine if the request is legitimate and compliant with OSC rules regarding market conduct and fair trading practices. This proactive stance helps prevent potential violations and ensures the FCM acts in a responsible and ethical manner, upholding its fiduciary duties. An incorrect approach would be to immediately refuse the delivery request solely based on its unusual nature. This failure to investigate could lead to a missed opportunity for a legitimate client transaction and potentially violate the principle of providing services to clients, unless there is a clear regulatory or ethical prohibition. Another incorrect approach is to proceed with the delivery without any inquiry, assuming the client's request is always valid. This overlooks the FCM's responsibility to monitor for manipulative trading practices and could inadvertently facilitate market abuse, contravening OSC regulations designed to protect market integrity. Finally, attempting to fulfill the request by encouraging other market participants to take offsetting positions without full disclosure of the underlying delivery obligation would be unethical and a violation of market conduct rules, as it could mislead other traders and create artificial market conditions. Professionals should adopt a decision-making framework that prioritizes understanding the client's intent and the commercial rationale behind any unusual trading or delivery request. This involves open communication with the client, diligent research into the feasibility and implications of the request, and a constant awareness of regulatory obligations. When in doubt, consulting with legal counsel or compliance officers is crucial to ensure adherence to all applicable laws and ethical standards. Question 10. The evaluation methodology shows that a client in California wishes to trade E-mini S&P 500 futures contracts. The current price of the E-mini S&P 500 index is 4,500. The contract multiplier for the E-mini S&P 500 is $50. The initial margin requirement set by the exchange is $10,000 per contract, and the maintenance margin is $8,000 per contract. The client has $50,000 in liquid capital available for trading. Assuming the client intends to trade one contract, what is the most appropriate calculation to determine the maximum potential financial risk to the client's capital for this single trade, according to the regulatory framework governing futures markets in the United States? Option A. Maximum potential loss per contract equals maintenance margin requirement equals $8,000. This is the minimum equity required in the account. Option B. Maximum potential loss per contract equals client's available capital equals $50,000. This is the total amount the client can afford to lose. Option C. Maximum potential loss per contract equals contract multiplier asterisk current index price equals $50 asterisk 4,500 equals $225,000. This represents the total notional value at risk. Option D. Maximum potential loss per contract equals initial margin requirement equals $10,000. This is the amount the client could lose before a margin call. The correct answer is C. Maximum potential loss per contract equals contract multiplier asterisk current index price equals $50 asterisk 4,500 equals $225,000. This represents the total notional value at risk. Explanation. The evaluation methodology shows a scenario that is professionally challenging due to the inherent volatility of futures markets and the need for precise risk assessment to protect client capital. A registered person must not only understand the mechanics of futures trading, but also the regulatory obligations surrounding risk disclosure and suitability. The core challenge lies in accurately quantifying potential losses and ensuring that the proposed trading strategy aligns with the client's financial capacity and risk tolerance, as mandated by the Commodity Futures Trading Commission, CFTC, regulations and National Futures Association, NFA, rules. The best approach involves calculating the maximum potential loss based on the initial margin requirement and the contract's notional value, then comparing this to the client's available capital. This method directly addresses the regulatory requirement to ensure that a client's account can withstand potential adverse price movements. Specifically, the calculation of the maximum loss per contract, considering the margin and the full contract value, provides a clear and quantifiable measure of risk. This aligns with the ethical duty to act in the client's best interest and the regulatory imperative to prevent clients from incurring losses beyond their means. An incorrect approach would be to solely consider the initial margin as the maximum potential loss. This fails to account for the fact that losses can exceed the initial margin, potentially leading to margin calls, and further losses up to the full notional value of the contract. This misrepresentation of risk is a direct violation of disclosure requirements and can lead to a client being exposed to unacceptable levels of risk, breaching fiduciary duties. Another incorrect approach is to focus only on the potential profit without a corresponding rigorous assessment of the maximum possible loss. Futures markets offer leverage, meaning that while profits can be amplified, so can losses. Ignoring the downside risk in favor of potential gains is a fundamental failure in risk management and violates the principle of providing a balanced and accurate risk assessment to clients. A further incorrect approach would be to base the risk assessment on a hypothetical, optimistic market scenario. While understanding market sentiment is important, regulatory compliance and ethical practice demand a worst-case scenario analysis. Relying on favorable assumptions without a robust calculation of maximum potential loss is a dereliction of duty and exposes the client to undue risk. The professional decision-making process for similar situations should involve a systematic risk assessment framework. This includes 1. Understanding the client's financial situation, investment objectives, and risk tolerance. 2. Thoroughly understanding the specific futures contract being considered, including its notional value, margin requirements, and historical volatility. 3. Calculating the maximum potential loss per contract, considering the full notional value. 4. Comparing the potential maximum loss to the client's available capital and risk tolerance. 5. Clearly disclosing all risks to the client, including the possibility of losing more than the initial investment. 6. Ensuring the proposed trade is suitable for the client based on the comprehensive risk assessment. Question 11. Compliance review shows that a non-clearing member firm in Illinois is considering different methods for handling customer funds received from clients trading futures contracts. Which of the following approaches best adheres to the regulatory framework governing such firms under the Commodity Exchange Act and National Futures Association rules? Option A. Directly remitting all customer funds to the clearing member firm's designated segregated account. Option B. Temporarily holding customer funds in the non-clearing member firm's operating account before remitting them to the clearing member. Option C. Allowing individual account executives to hold customer funds in their personal accounts before depositing them with the clearing member. Option D. Using customer funds to cover the non-clearing member firm's operational expenses, with a plan to repay the funds later. The correct answer is A. Directly remitting all customer funds to the clearing member firm's designated segregated account. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a non-clearing member firm to navigate the complexities of its relationship with a clearing member firm, particularly concerning the handling of customer funds and the potential for conflicts of interest. The firm must ensure its operational procedures and internal controls are robust enough to protect customer assets and maintain compliance with the Commodity Exchange Act, C, and National Futures Association, NFA rules, specifically those pertaining to segregation of customer funds and the responsibilities of introducing brokers. The firm's judgment is critical in selecting the most appropriate method for handling customer funds to ensure regulatory adherence and client protection. Correct approach analysis. The best professional practice involves the non-clearing member firm directly remitting all customer funds to the clearing member firm's segregated account. This approach is correct because it aligns directly with the regulatory mandate under the CEA and NFA rules that customer funds must be segregated and held in a manner that protects them from the proprietary business of the firm. By ensuring funds are immediately transferred to the clearing member's designated segregated account, the non-clearing member firm fulfills its obligation to safeguard customer assets and avoids any commingling or misuse of these funds. This direct remittance minimizes the risk of operational errors or intentional diversion of funds, thereby upholding the highest ethical standards and regulatory compliance. Incorrect approach is analysis. Holding customer funds temporarily in the non-clearing member firm's own operating account before remitting them to the clearing member is a regulatory failure. This practice risks commingling customer funds with the firm's own capital, which is a direct violation of segregation requirements under the CEA and NFA rules. Such commingling exposes customer assets to the firm's creditors and operational risks, undermining the fundamental principle of customer protection. Using customer funds to cover operational expenses of the non-clearing member firm, even with the intention of repaying them later, is a severe ethical and regulatory breach. This constitutes a misappropriation of customer funds, a clear violation of the CEA and NFA rules designed to prevent fraud and protect investors. It demonstrates a disregard for fiduciary duties and the integrity of the futures markets. Allowing individual account executives to hold customer funds in their personal accounts before depositing them with the clearing member is also unacceptable. This practice introduces significant risks of loss, theft, or diversion of funds, and bypasses the firm's internal controls and the required segregation of customer assets. It is a direct contravention of the strict requirements for handling customer funds and maintaining proper accounting and oversight. Professional reasoning. Professionals in this situation must prioritize regulatory compliance and customer asset protection above all else. The decision-making process should begin with a thorough understanding of the specific requirements of the CEA and NFA rules regarding the handling of customer funds by introducing brokers and their relationship with clearing members. When faced with options for handling customer funds, the primary consideration should be which approach most effectively ensures immediate and complete segregation of these funds from the firm's own assets. Any method that involves temporary holding, commingling, or direct use of customer funds by the non-clearing member firm, regardless of intent, should be immediately rejected. The professional standard dictates a direct and transparent process that minimizes risk and maximizes the protection of client assets, aligning with the principles of integrity and trust essential to the financial industry. Question 12. Analysis of a floor broker's actions in the United States when presented with two client orders for the same commodity futures contract arriving almost simultaneously, but with one order being placed milliseconds before the other, and the broker has a brief opportunity to execute the earlier order at a favorable price before the market shifts. Which of the following represents the most appropriate professional conduct? Option A. Execute the order that was placed first at the best available price at that moment, regardless of the size or potential profitability of the second order. Option B. Execute the larger of the two orders first, believing it may offer a better opportunity for price improvement or a more significant commission. Option C. Delay the execution of the first order to see if the market moves favorably for the second, later arriving order, or for the broker's own proprietary account. Option D. Execute the order for the client who typically trades larger volumes or offers a slightly higher commission, assuming this client is more valuable. The correct answer is A. Execute the order that was placed first at the best available price at that moment, regardless of the size or potential profitability of the second order. Explanation. This scenario presents a professional challenge because a floor broker, acting as an agent for multiple clients, must navigate potential conflicts of interest and ensure fair execution of orders in a dynamic trading environment. The floor broker's primary duty is to act in the best interest of their clients, which includes achieving the most favorable execution price and avoiding any actions that could disadvantage one client for the benefit of another or themselves. The speed of trading on the floor necessitates quick decision-making, but this must be balanced with strict adherence to regulatory obligations and ethical principles. The best professional approach involves prioritizing the client who placed the order first and executing it at the best available price at that moment, without regard for subsequent orders or personal interest. This aligns with the regulatory framework in the United States, specifically the Commodity Exchange Act (C) and the rules enforced by the Commodity Futures Trading Commission (CFTC) and the National Futures Association (NFA). These regulations emphasize the fiduciary duty of brokers to their clients, requiring them to execute orders promptly and in a manner that achieves the best execution reasonably available. By executing the earlier order first at the prevailing market price, the floor broker upholds this duty, ensuring that the client who initiated the transaction receives fair treatment and the benefit of the market conditions at the time of their order. This also prevents the appearance or reality of front-running or preferential treatment. An incorrect approach would be to execute the order for the client who offered a slightly better commission or who is a more frequent trader, even if their order arrived later. This violates the principle of first in, first out, and prioritizes personal gain or a relationship over the client's right to timely and fair execution. Such an action could be construed as a breach of fiduciary duty and potentially violate regulations against preferential treatment and manipulative practices. Another incorrect approach would be to delay execution of the earlier order to see if the market moves in a direction that would benefit a later arriving client or the broker's own proprietary position. This constitutes a failure to execute promptly and can lead to a worse execution price for the client whose order was placed first, thereby breaching their trust and violating regulatory mandates for best execution. Finally, An incorrect approach would be to execute the later order first because it is for a larger quantity, assuming it might be more profitable. While larger orders can sometimes be more complex, the fundamental principle of executing orders in the sequence they are received, at the best available price at that time, remains paramount. Deviating from this sequence without a clear, client-benefiting rationale, e.g., a specific block trading strategy agreed upon with the client, is a regulatory and ethical misstep. Professionals should employ a decision-making framework that prioritizes the established order sequence and the principle of best execution. This involves understanding the client's instructions, recognizing the prevailing market conditions, and executing trades in a manner that is fair and equitable to all clients, strictly adhering to the first-in, first-out principle unless specific client instructions or regulatory exceptions dictate otherwise. A clear mental checklist of regulatory obligations and ethical considerations should be applied before executing any trade, especially when multiple orders are present. Question 13. The review process indicates that a futures commission merchant, FCM, located in Illinois is advising a client who holds a short position in a Chicago Mercantile Exchange, CME, live cattle futures contract that is approaching first notice day. Which of the following approaches best demonstrates professional responsibility and compliance with the Commodity Exchange Act and relevant exchange rules? Option A. Proactively contact the client well in advance of first notice day to explain the implications of their short position regarding potential physical delivery, confirm their intentions, and outline the procedures for avoiding delivery if desired. Option B. Focus on the FCM's internal procedures for processing delivery notices and inform the client only after a delivery notice has been received and processed. Option C. Send a general market advisory to all clients that mentions first notice day for live cattle futures without specifying individual client positions or potential exposures. Option D. Assume the client is aware of the delivery implications of their short position and only provide information if the client specifically inquires about first notice day. Correct answer is A. Proactively contact the client well in advance of first notice day to explain the implications of their short position regarding potential physical delivery, confirm their intentions, and outline the procedures for avoiding delivery if desired. Explanation. The review process indicates a scenario where a futures commission merchant, FCM, in Illinois must navigate the complexities of first notice day for a commodity futures contract. This situation is professionally challenging because first notice day triggers specific obligations and potential liabilities for both the FCM and its clients. Misunderstanding or mishandling these obligations can lead to regulatory violations, financial losses for clients, and reputational damage for the FCM. Careful judgment is required to ensure compliance with the Commodity Exchange Act C and the rules of the relevant exchanges, particularly concerning the timely and accurate dissemination of information and the proper handling of delivery intentions. The best professional practice involves proactively communicating with clients regarding their positions and potential delivery obligations well in advance of first notice day. This includes clearly explaining the implications of holding a long or short position that could result in physical delivery, outlining the procedures for avoiding delivery if desired, and confirming the client's intentions. This approach is correct because it aligns with the FCM's duty to supervise its customers' accounts and to ensure that clients are fully informed about the risks and obligations associated with their futures positions, especially as delivery approaches. Regulatory bodies, such as the National Futures Association, NFA, and the Commodity Futures Trading Commission, CFTC, emphasize the importance of clear communication and client education to prevent inadvertent defaults or unexpected liabilities. An approach that delays communication until the last possible moment or assumes client awareness of delivery obligations without explicit confirmation is professionally unacceptable. This failure to proactively inform clients about first notice day implications and their potential delivery responsibilities constitutes a breach of the FCM's supervisory duties. It exposes clients to significant risk of unexpected costs, penalties, or the obligation to take or make physical delivery, which they may not be prepared for. Such an action can be viewed as a violation of the CEA's anti-fraud and anti-manipulation provisions, as well as NFA rules requiring adequate supervision and customer protection. Another professionally unacceptable approach is to provide generic, nonspecific information about first notice day without tailoring it to the client's specific position and potential exposure. While some information may be provided, it lacks the crucial detail needed for a client to make informed decisions. This can lead to misunderstandings and unintended consequences, failing to meet the standard of care expected of an FCM. Finally, an approach that focuses solely on the FCM's internal processes for handling delivery notices, without ensuring the client understands their role and options, is also flawed. The FCM's responsibility extends beyond its own operational efficiency to encompass the client's understanding and management of their position's implications on first notice day. Professionals should adopt a decision-making framework that prioritizes client education and proactive communication. This involves understanding the specific contract specifications, the implications of first notice day for both long and short positions, and the regulatory requirements for FCMs. Before first notice day, FCMs should review client positions, identify those at risk of delivery, and initiate clear, personalized communications to explain obligations, options, and deadlines. This ensures clients can make informed decisions and avoid adverse outcomes, thereby upholding regulatory standards and ethical obligations. Question 14. Performance analysis shows that a futures commission merchant, FCM, operating in California has received a substantial deposit from a new client. Simultaneously, another client of the FCM is facing an imminent margin call on an existing futures position. The FCM's internal operations team suggests using the new client's deposit to cover the existing client's margin call to avoid a liquidation of that position, with the intention of segregating the new client's funds later in the day once operational capacity allows. What is the most appropriate course of action for the FCM? Option A. Delay the segregation of the new client's funds until the end of the trading day to manage operational workflow and then deposit them into the segregated account. Option B. Utilize the new client's deposit to meet the margin call for the other client, as this is a common practice to manage client positions efficiently. Option C. Use the new client's funds to cover the existing client's margin call and inform the new client of this action for their subsequent approval. Option D. Immediately segregate the new client's funds into a dedicated customer segregated account as required by CFTC regulations. The correct answer is D. Immediately segregate the new client's funds into a dedicated customer segregated account as required by CFTC regulations. Explanation. Scenario analysis. This scenario presents a professional challenge for a futures commission merchant, FCM, in California due to the inherent conflict between client instructions and regulatory obligations. The FCM must navigate the delicate balance of respecting client autonomy while upholding its fiduciary duty and adhering to the stringent requirements of the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA, regarding customer funds. Mismanagement of segregated funds can lead to severe regulatory penalties, reputational damage, and loss of client trust. Correct approach analysis. The best professional practice involves immediately segregating the client's funds as required by CFTC regulations. This approach is correct because CFTC Rule 1, when he mandates that all money, securities, and property received by an FCM in connection with a futures contract or an option on a futures contract must be kept separate from the FCM's own funds and held in a segregated account. This segregation ensures that customer assets are protected and available for their intended purpose, preventing commingling with the FCM's operating capital, which could be subject to the FCM's creditors. Incorrect approach is analysis. One incorrect approach involves using the client's funds to cover a margin call on another client's account. This is a direct violation of CFTC Rule 1.20 and NFA rules, which strictly prohibit the commingling of customer funds and the use of one customer's assets to satisfy the obligations of another. Such an action constitutes misappropriation of customer funds and a breach of fiduciary duty. Another incorrect approach is to delay segregation until the end of the trading day. CFTC regulations require prompt segregation of customer funds. Delaying this process, even for a short period, exposes customer assets to potential risk if the FCM experiences financial difficulties during that interim. It also creates an opportunity for inadvertent commingling. A third incorrect approach is to inform the client that their funds will be used for the other client's margin call, seeking their retroactive approval. While transparency is important, it does not absolve the FCM of its regulatory obligations. The FCM cannot solicit or accept approval for an action that is fundamentally illegal and against regulatory mandates. The client's consent cannot legitimize a regulatory violation. Professional reasoning. Professionals in this situation must prioritize regulatory compliance above all else when dealing with customer funds. The decision-making process should involve 1. Immediately identifying the regulatory requirement for segregation of customer funds. 2. Recognizing the prohibition against commingling and using one customer's funds for another's obligations. 3. Acting to segregate the funds as per regulations, even if it means addressing the other client's margin call through alternative, compliant means, e.g., requesting additional funds from that client. 4. Consulting with compliance or legal departments if there is any ambiguity. Question 15. Market research demonstrates that a financial instrument is a standardized, exchange-traded agreement to buy or sell a specific quantity of a commodity or financial instrument at a predetermined price on a future date, with the primary purpose of managing price volatility or speculating on price movements. In the United States, how should this instrument be classified and regulated? Option A. As a security, regulated by the Securities and Exchange Commission, SEC, under the Securities Act of 1933 and the Securities Exchange Act of 1934. Option B. As a forward contract, subject to general contract law principles. Option C. As an insurance product, regulated by state insurance commissioners. Option D. As a futures contract, regulated by the Commodity Futures Trading Commission, CFTC, under the Commodity Exchange Act, C. The correct answer is D. As a futures contract, regulated by the Commodity Futures Trading Commission, CFTC, under the Commodity Exchange Act, C. Explanation. This scenario presents a professional challenge because it requires a clear understanding of the fundamental differences between futures contracts and securities, particularly concerning their regulatory treatment, and the implications for investor protection and market integrity within the United States. Mischaracterizing these instruments can lead to significant regulatory violations, investor harm, and reputational damage for the firm and its associated persons. Careful judgment is required to ensure compliance with the Commodity Exchange Act, C, and the Securities Exchange Act of 1934, as well as the rules and regulations promulgated by the Commodity Futures Trading Commission, CFTC, and the Securities and Exchange Commission, SEC. The best professional approach involves accurately identifying the underlying nature of the investment product. Futures contracts, as defined by the CEA, are standardized agreements to buy or sell a commodity or financial instrument at predetermined price on a specified future date. They are primarily regulated by the CFTC. Securities, on the other hand, are typically investments in a company like stocks or debt instruments like bonds, and are regulated by the SEC under the Securities Act of 1933 and the Securities Exchange Act of 1934. A product that is a standardized, exchange-traded agreement for future delivery of a commodity or financial instrument, with the primary purpose of hedging price risk or speculation on price movements, is unequivocally a futures contract. This classification dictates the appropriate regulatory framework, disclosure requirements, and suitability standards that must be applied. An incorrect approach would be to classify a futures contract as a security. This is a fundamental regulatory error. Securities are generally considered to represent ownership or a creditor relationship in an entity. Futures contracts, by contrast, are derivative instruments whose value is derived from an underlying asset but do not represent ownership in that asset. Regulating a futures contract as a security would subject it to SEC oversight, which is inappropriate and would bypass the established regulatory regime overseen by the CFTC, potentially exposing investors to inadequate protections specific to the futures market and failing to adhere to the CEA's provisions. Another incorrect approach would be to consider a futures contract as a simple forward contract. While both are agreements for future delivery, futures contracts are standardized, exchange-traded, and subject to clearinghouse guarantees, offering a higher degree of liquidity and reduced counterparty risk compared to customized, over-the-counter forward contracts. Failing to recognize this distinction means overlooking the specific regulatory framework and market mechanisms that govern futures, which are designed to ensure fair and orderly trading and protect market participants. A further incorrect approach would be to view a futures contract as a form of insurance. While futures can be used for hedging, which shares a risk management aspect with insurance, they are not insurance products. Insurance contracts are designed to protect against specific, unforeseen events, typically involving indemnification for loss. Futures contracts are primarily financial instruments used to manage price risk or speculate on price changes in underlying commodities or financial instruments. Reading a futures contract as insurance would misrepresent its function and regulatory classification, leading to the application of incorrect rules and potentially misleading investors about the nature of their investment and the risks involved. Professionals should employ a decision-making framework that begins with a thorough understanding of the product's characteristics as defined by relevant statutes and regulations. This involves analyzing whether the instrument is standardized. Exchange-traded involves leverage, and its primary purpose, hedging price risk vs. ownership/debt. If the instrument fits the definition of a futures contract under the CEA, it must be treated as such, adhering to CFTC regulations. If it fits the definition of a security under the Securities Act of 1933 or the Securities Exchange Act of 1934, it must be treated as such, adhering to SEC regulations. This rigorous, definition-based approach ensures compliance and appropriate investor protection. Question 16. Investigation of a client's request to transfer ownership of their commodity futures account to their adult child in Illinois reveals a desire to expedite the process. What is the most appropriate and compliant course of action for the introducing broker? Option A. Allow the adult child to begin trading on the existing account immediately, with the understanding that ownership will be formally transferred at a later date. Option B. Require the adult child to complete a new account application and undergo the firm's standard Know Your Customer (KIC) verification process, initiating a formal account transfer. Option C. Re-register the existing account in the adult child's name based solely on the current client's written instruction and identification. Option D. Advise the current client to close their account and have the adult child open a completely new account without any formal transfer procedures. Correct answer is B. Require the adult child to complete a new account application and undergo the firm's standard Know Your Customer (KIC) verification process, initiating a formal account transfer. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves a client's desire to transfer ownership of a commodity futures account to a family member, which touches upon regulatory requirements for account transfers, anti-money laundering, AML considerations, and the fiduciary duty owed to the client. Navigating these aspects requires careful judgment to ensure compliance with the Commodity Futures Trading Commission, CFTC regulations, and the National Futures Association, NFA rules, specifically concerning account transfers and customer identification. Correct approach analysis. The best professional practice involves initiating a formal account transfer process that requires the recipient to complete a new account application and undergo a thorough Know Your Customer (KIC) verification. This approach is correct because it directly adheres to CFTC Rule 137 and NFA Rule 2-30, which mandate that introducing brokers and futures commission merchants must obtain essential customer information and perform due diligence before accepting or transferring accounts. This process ensures that the new owner is properly identified, assessed for suitability, and that the firm meets its obligations to prevent illicit financial activities. Incorrect approach is analysis. One incorrect approach is to simply re-register the account in the family member's name based solely on the client's instruction without any further verification. This fails to comply with KYC requirements, potentially exposing the firm to risks associated with money laundering or fraud, and violating the spirit and letter of CFTC and NFA regulations regarding customer identification and account opening procedures. Another incorrect approach is to allow the family member to trade on the existing account without formally transferring ownership or completing any new account documentation. This creates significant compliance and record-keeping issues, as the account's beneficial owner is not accurately reflected, leading to potential violations of record-keeping rules and customer protection regulations. Finally, advising the client to close the existing account and have the family member open a new one without facilitating a formal transfer process, while seemingly a workaround, still bypasses the necessary due diligence and verification steps required for a legitimate account transfer, thus failing to meet regulatory standards for account integrity. Professional reasoning. Professionals should approach such situations by prioritizing regulatory compliance and client protection. The decision-making process should involve 1. Recognizing the regulatory implications of account transfers, particularly under CFTC and NFA rules. 2. Understanding the importance of robust KYC and AML procedures for all new and transferred accounts. 3. Initiating the firm's established, compliant account transfer protocol, which includes new applications and verification. 4. Communicating clearly with the client about the required steps and the reasons behind them, emphasizing the firm's commitment to regulatory adherence and the client's best interests. Question 17. Comparative studies suggest that understanding normal market conditions is crucial for futures commission merchants in the United States. If a futures commission merchant observes a significant price increase in a particular agricultural commodity futures contract, accompanied by a substantial surge in trading volume, what is the most prudent course of action to ensure compliance with the Commodity Exchange Act and maintain market integrity? Option A. Focus solely on the potential commission revenue generated by the increased trading activity, without further investigation into the underlying causes of the price and volume surge. Option B. Conduct a comprehensive analysis of the contract's trading data, including volume, open interest, and price action, in conjunction with relevant fundamental factors affecting the underlying commodity, to determine if the price movement is consistent with normal market forces. Option C. Proceed with facilitating trades for clients who wish to capitalize on the rapid price movement, as high volume often signifies a healthy, active market. Option D. Immediately cease all trading in that futures contract, assuming the price surge and volume indicate potential market manipulation. Correct answer is B. Conduct a comprehensive analysis of the contract's trading data, including volume, open interest, and price action, in conjunction with relevant fundamental factors affecting the underlying commodity, to determine if the price movement is consistent with normal market forces. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a futures commission merchant, FCM, to distinguish between legitimate price discovery in a normal market and potential manipulative activity that could harm market integrity and investors. The FCM must act diligently to protect its clients and uphold regulatory standards, even when faced with potentially profitable but ethically questionable trading opportunities. The challenge lies in applying the principles of normal market behavior to a specific, dynamic situation without resorting to simplistic assumptions. Correct approach analysis. The best professional practice involves a thorough, fact-based assessment of market conditions and trading patterns. This approach requires the FCM to analyze the specific contract, the trading volume, open interest, and the relationship between these factors and the underlying commodities fundamentals. It also necessitates considering the nature of the trades being executed. Are they consistent with typical hedging, speculative, or arbitrage activities, or do they appear designed to artificially influence prices? This aligns with the Commodity Futures Trading Commission's CFTC mandate under the Commodity Exchange Act, C, to ensure fair and orderly markets and prevent manipulation. A diligent FCM would consult relevant market data, historical trends, and potentially engage with exchange surveillance to confirm that the observed price movements are a natural consequence of supply and demand, rather than artificial influence. Incorrect approaches analysis. One incorrect approach involves assuming that any price movement accompanied by high volume is inherently indicative of a normal market. This fails to acknowledge that manipulative schemes can also generate significant volume and price changes. Ethically and regulatorily, this approach is flawed because it bypasses the due diligence required to identify potential manipulation, thereby failing to protect clients and market integrity. Another incorrect approach is to immediately halt all trading in a particular contract simply because prices are moving rapidly, regardless of the underlying reasons. While caution is important, an outright cessation of trading without a proper assessment can be detrimental to legitimate market participants who are engaging in normal hedging or speculative activities. This approach is not supported by regulatory frameworks that aim to facilitate, not stifle, legitimate trading. A third incorrect approach is to focus solely on the profitability of the trades for the FCM or its clients, without adequately considering the broader market implications or the potential for manipulative intent. This prioritizes short-term financial gain over the FCM's fiduciary duty and its obligation to comply with regulations designed to prevent market abuse. Such a focus can lead to complicity in manipulative practices, which carries severe regulatory penalties. Professional reasoning. Professionals should adopt a framework that prioritizes due diligence, regulatory compliance, and market integrity. This involves 1. Understanding the characteristics of a normal market for the specific commodity and contract. 2. Actively monitoring trading activity for deviations from normal patterns. 3. Investigating any anomalies by gathering and analyzing relevant data, including volume, open interest, price action, and fundamental market factors. 4. Consulting with exchange surveillance or regulatory bodies when suspicion of manipulation arises. 5. Acting in the best interest of clients and the market, even if it means foregoing potentially profitable but questionable trades. Question 18. The investigation demonstrates that a registered futures commission merchant in the United States is experiencing significant operational challenges due to an unexpected surge in trading volume, leading to difficulties in meeting its daily margin calls to the clearinghouse. Which of the following actions best addresses this situation while adhering to regulatory requirements and best practices for clearinghouse functions? Option A. Delay reporting the operational issues to the clearinghouse while attempting to resolve the liquidity problems internally through short-term borrowing from affiliated entities. Option B. Prioritize fulfilling obligations to other bilateral counterparties before addressing the clearinghouse margin calls to conserve available liquidity. Option C. Immediately notify the clearinghouse of the operational strain and consult the FCM's pre-established contingency plan for managing liquidity shortfalls. Option D. Seek an unsecured, informal line of credit from a non-clearing member firm to cover potential margin shortfalls without disclosing the arrangement to the clearinghouse. The correct answer is C. Immediately notify the clearinghouse of the operational strain and consult the FCM's pre-established contingency plan for managing liquidity shortfalls. Explanation. The investigation demonstrates a scenario where a futures commission merchant, FCM, is experiencing operational strain due to a sudden surge in trading volume, impacting its ability to meet its obligations to the clearinghouse. This situation is professionally challenging because it directly tests the FCM's risk management protocols and its understanding of its fundamental role within the clearinghouse ecosystem. Failure to manage this strain can have systemic implications, affecting market stability and the financial integrity of the clearinghouse itself. Careful judgment is required to balance immediate operational pressures with long-term regulatory compliance and market responsibilities. The best approach involves proactively communicating the operational challenges to the clearinghouse and initiating a prearranged contingency plan. This approach is correct because it aligns with the core principles of clearinghouse operations, which are designed to mitigate systemic risk through transparency and preparedness. By informing the clearinghouse immediately, the FCM upholds its regulatory obligation to maintain open communication regarding its financial and operational status. This allows the clearinghouse to assess potential risks, adjust its own risk management strategies, and potentially offer support or guidance, thereby safeguarding the market. This proactive stance is a cornerstone of responsible participation in the futures market, as mandated by regulations such as those overseen by the Commodity Futures Trading Commission, CFTC, in the United States, which emphasize robust risk management and timely reporting. An incorrect approach involves delaying communication with the clearinghouse while attempting to resolve the operational issues internally. This is professionally unacceptable because it violates the principle of transparency and can exacerbate the risk to the clearinghouse and other market participants. The delay prevents the clearinghouse from taking necessary actions, potentially leading to a default or a more severe market disruption. This failure to report promptly is a direct contravention of regulatory requirements that mandate timely disclosure of material information that could impact an FCM's ability to meet its obligations. Another incorrect approach is to seek an unsecured loan from a related party to cover potential margin shortfalls without informing the clearinghouse. This is professionally unacceptable as it attempts to circumvent the established clearing and settlement processes and introduces an undisclosed financial risk. Relying on informal financing arrangements without clearinghouse knowledge or approval undermines the integrity of the margining system and can create hidden exposures that the clearinghouse is not equipped to manage. This practice is contrary to the regulatory framework, designed to ensure that all financial obligations are transparently managed and collateralized according to established rules. Finally, an incorrect approach is to prioritize fulfilling obligations to other counterparties over the clearinghouse during a liquidity crunch. This is professionally unacceptable because the clearinghouse acts as the central counterparty to all trades, and its stability is paramount. Failing to meet clearinghouse obligations, even to satisfy other bilateral agreements, can trigger default procedures and have cascading negative effects on the entire market. The regulatory framework, particularly under the purview of the CFTC, emphasizes the clearinghouse's central role and the priority that must be given to meeting its requirements to ensure market integrity and prevent systemic risk. Professionals should employ a decision-making framework that prioritizes transparency, regulatory compliance, and risk mitigation. When facing operational challenges, the first step should always be to assess the potential impact on clearinghouse obligations. This assessment should then trigger immediate communication with the clearinghouse and the activation of predefined contingency plans. Understanding the specific regulatory requirements for reporting and risk management, as enforced by bodies like the CFTC, is crucial for navigating such situations ethically and effectively. Question 19. Assessment of the regulatory responsibilities of a Futures Commission merchant, FCM, in the United States when a high-volume client begins executing a series of trades that appear to be wash sales or matched orders in the soybean futures market, raising concerns about potential market manipulation. Option A. The FCM should simply advise the client to cease the unusual trading activity without further investigation or reporting. Option B. The FCM should immediately report the client to the CFTC without conducting any internal investigation or seeking clarification from the client. Option C. The FCM's compliance department should actively monitor the trading activity, investigate the patterns, and if manipulation is suspected, file a suspicious activity report (SAR) with the CFTC and relevant SROs. Option D. The FCM should ignore the unusual trading patterns as long as the client is a high-volume trader and has not explicitly stated an intent to manipulate the market. The correct answer is C. The FCM's compliance department should actively monitor the trading activity, investigate the patterns, and if manipulation is suspected, file a suspicious activity report (SAR) with the CFTC and relevant SROs. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a Futures Commission merchant, FCM, to balance the need to facilitate client trading with the fundamental obligation to prevent market manipulation and ensure fair trading practices, as mandated by the Commodity Futures Trading Commission, CFTC, under the Commodity Exchange Act, C, in the United States. The FCM must exercise due diligence to identify and report suspicious trading activity without unduly hindering legitimate market participation. Correct approach analysis. The best professional practice involves the FCM's compliance department actively monitoring trading activity for patterns indicative of manipulative practices, such as wash trading or matched orders. Upon identifying such patterns, the FCM should promptly investigate the trades, gather relevant information from the client, and if the investigation confirms potential manipulation, file a suspicious activity report (SAR) with the CFTC and relevant self-regulatory organizations, SRO like the National Futures Association, NFA. This approach directly aligns with the FCM's regulatory obligations under the CEA to maintain adequate supervision and control over its business and to report suspicious activities that could undermine market integrity. The NFA's Interpretive Notice 99-10, Supervision of Introducing Brokers and Commodity Trading Advisors, and CFTC Regulation 135, which requires FCMs to maintain records of customer orders, also support this proactive and reporting-driven approach. Incorrect approaches analysis. One incorrect approach involves the FCM ignoring the unusual trading patterns simply because the client is a high-volume trader and has not explicitly stated an intent to manipulate the market. This failure constitutes a breach of the FCM's duty of supervision and its obligation to detect and report manipulative trading. The CEA and CFTC regulations do not permit an FCM to disregard red flags based solely on client volume or the absence of explicit manipulative intent. The focus is on the nature of the trading activity itself. Another incorrect approach is for the FCM to immediately report the client to the CFTC without conducting any internal investigation or seeking clarification from the client. While prompt reporting is crucial for suspicious activity, an FCM must first exercise reasonable diligence to understand the context of the trades. Premature reporting without due diligence could lead to unwarranted scrutiny of a client's legitimate trading strategies and damage the client relationship, while also potentially misallocating regulatory resources. A third incorrect approach is for the FCM to simply advise the client to cease the unusual trading activity without further investigation or reporting. While discouraging potentially problematic trading is a step, it does not absolve the FCM of its responsibility to investigate and report if the activity appears to be manipulative. The FCM must fulfill its regulatory reporting obligations, even if the client agrees to alter their behavior. Professional reasoning. Professionals should adopt a framework that prioritizes regulatory compliance and market integrity. This involves establishing robust internal controls and surveillance systems to monitor trading activity. When suspicious patterns emerge, a systematic investigation process should be initiated, including client communication where appropriate. The decision to report to regulatory bodies should be based on the findings of this investigation, adhering to established reporting thresholds and timelines. This layered approach ensures that legitimate trading is facilitated, while manipulative practices are identified and addressed effectively, in accordance with CFTC and NFA requirements. Question 20. Benchmark analysis indicates that a large agricultural cooperative in Illinois, hedging its upcoming soybean harvest, is considering using Chicago Board of Trade (CBOT) corn futures contracts due to their high liquidity and correlation with soybean prices. The cooperative has provided historical data showing the standard deviation of daily soybean price changes is $0.15 per bushel. The standard deviation of daily CBOT corn futures price changes is $0.12 per bushel, and the correlation coefficient between daily soybean price changes and daily CBOT corn futures price changes is 0.85. The cooperative plans to hedge 100,000 bushels of soybeans. What is the optimal number of corn futures contracts to hedge, assuming each contract represents 5,000 bushels? Option A, 25 contracts. Option B, 17 contracts. Option C, 15 contracts. Option D, 20 contracts. The correct answer is B, 17 contracts. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a commodity futures professional to not only understand the mechanics of futures trading, but also to apply specific regulatory knowledge from the United States to a practical hedging situation. The challenge lies in accurately calculating the optimal hedge ratio, considering the basis risk, and ensuring the hedging strategy aligns with the client's objectives and regulatory requirements under the Commodity Exchange Act, C, and CFTC regulations. Miscalculation or misapplication of hedging principles can lead to significant financial losses for the client and potential regulatory violations for the professional. Correct approach analysis. The best professional practice involves calculating the optimal hedge ratio using the standard formula that accounts for the price sensitivity of the asset being hedged and the futures contract. This approach is correct because it directly addresses the core principle of hedging, minimizing price risk by taking an offsetting position in the futures market. The formula H equals rho C frac sigma S sigma Y where rho C is the correlation between the spot price and futures price. Sigma S is the standard deviation of spot price changes, and sigma Y is the standard deviation of futures price changes, is the industry standard method for determining the most effective hedge ratio. This method is supported by the principles of risk management and is implicitly endorsed by regulatory bodies like the CFTC, which expect professionals to employ sound risk management techniques. By using this formula, the professional ensures the hedge is as effective as possible in mitigating the client's exposure to price fluctuations in their soybean crop. Incorrect approaches analysis. An approach that simply hedges 1-to-1, 100% of the physical quantity, is incorrect because it fails to account for the differing price volatilities of the spot commodity, soybeans, and the futures contract, corn. This can lead to overhedging or underhedging, exposing the client to unintended price risk. This approach disregards the fundamental concept of basis risk and the need for an optimal hedge ratio, potentially violating the duty to act in the client's best interest under CFTC regulations. An approach that hedges based solely on the current market price of soybeans without considering the futures contract's price or volatility is also incorrect. Futures contracts are distinct instruments with their own price discovery mechanisms and volatility characteristics. Ignoring these differences means the hedge will not be properly calibrated, leading to an ineffective risk reduction strategy. This demonstrates a lack of due diligence and a failure to apply appropriate hedging methodologies, which could be viewed as a violation of the professional conduct standards expected by the CFTC. An approach that hedges based on the expected price movement of corn futures, rather than the price sensitivity of soybeans to corn futures, is fundamentally flawed. While corn futures might be used to hedge soybeans, the hedge ratio must be derived from the relationship between soybean price changes and corn futures price changes, not simply the directional expectation of corn prices. This approach misapplies the hedging concept and fails to establish a statistically sound hedge, potentially exposing the client to significant, unmitigated risk and violating regulatory expectations for competent advice. Professional reasoning. Professionals should always begin by understanding the client's specific risk exposure and objectives. This involves gathering data on the asset to be hedged, soybean crop, and the available hedging instruments, corn futures. The next step is to identify the appropriate mathematical model for calculating the optimal hedge ratio, considering factors like price correlation and volatility. Professionals must then apply this model accurately, using reliable data. Finally, they should clearly communicate the hedging strategy, its assumptions, and its limitations to the client, ensuring informed consent and compliance with regulatory requirements for transparency and suitability.